used in production of goods and services. So it's used in actual production for selling. So it can be a raw material for your product. It can be in progress, means something is in the progress, or it can be finished goods, unsold finished goods. So you can categorize normally in three parts: the raw material which is not yet processed, products which are in development, and finished goods. Does service companies have fixed assets? If let's say you are selling a consulting assignment, you are doing a consulting, do you have inventory? What if you have a project which lasts for 6 months and you just got the product and maybe it's in the middle at the time of closing the financial statements? You have spent only 3 months. You finish only 3 months, but the service is not complete yet. So you will not get the money from the customer, right? But you spend 3 months salary on your staff. So what will that happen? You will recognize the income next year, right? When you complete the project. But you recognize the expense today for 3 months. So how you want to deal with it? Then 3 months expense is here, 3 months expense in the future, but 6 months of income in the future, right? So means you want to recognize this 3 months as inventory, means as maybe a cost of unsold services, and put into next year profit and loss statement. Otherwise this year profit and loss statement is hit. Correct? So service industries can have unfinished projects which you have been working on it but are not finished yet. So you don't have income recognition, but you have expense already. So you need to put that expense in the income in the year when you are servicing the income, or the research work which you are doing for future projects. So that also can be recognized as inventory, but it's highly depend on the company's policy. Okay, these are just examples. So you can have different policies, but you need to have a policy, because you need to have whatever policy you want to follow. You want to put into asset, you want to put into inventory, you want to put into an expense immediately, but you need to have a policy. For that why, so that you can follow it year on year, and you can explain whenever somebody asks what is this, so then you can explain how I am doing it. And it depends on your objective and your individual condition. Do you want to stay profitable? If you want to stay profitable, don't show it as an expense, right? Put into either expense or put into inventory. If you don't worry about the profitability, then you can decide however you want it. Okay? So the costing is another policy matter of inventory, means how you value the inventory. So what are the different values? Do you know? Have you heard of it? First in, first out. What is first in, first out? First in and first out. So if let's say you buy 2 apple, the first apple you buy at $10. Now next day and you are not able to sell it. In the market next day the price of apple go up to $12. Now you buy another apple also, right? Because you just want to buy. So now you have 2 apple. One costs $10, another costs $12. On third day you sell 1 apple. You don't know which one, because you don't mark. Because it's the same apple, doesn't matter which you buy it for $10 or $12, right? Now you sell for 13. So how much profit you make? 3 or 2, 3 or 1. Because you buy for 12 also, you buy for 10. Correct? So how much is your profit? Depend on your accounting policy, right? How you value your inventory. So first in, first out means I bought one, the latest at $10, right? So that will go out first. So means my profit will be 3. But if I have another policy called last in, first out, means the latest one I bought will go first. So what will be the profit now? 13 minus 12, 1. So same process, everything remain the same. The sale remain the same, purchase remain the same. The value is different. The profit is different. Correct? So you need to make an accounting policy. So accounting policy will affect your profitability. Another method is called weighted average. So now I bought 1 apple at 10, 1 apple at 12. So what is the average cost? 11. 10 plus 12 divided by 2. So each apple cost me 11 now. So whenever I'm selling at 13, I will make $2 profit, right? So which one is more preferable method?
First in, first out.
Well, first in, first out, yes, but then in that case you are showing a very high, if let's say the price are increasing of raw material, you show higher profit in the current, right? But low profit in the future years because the cost is not adjusted out yet. If the price are decreasing, your profit in the initial month will be low, in the future month will be higher, right? And also, but so what is the better way? For me, the most easier way is weighted average. Whatever you bought, you just weighted average, you just continue to adjust the average, especially when the item is not identifiable. Let's say you are buying apples, is you cannot differentiate, right? But you can differentiate in other, let's say you buy laptop also the same. But if you buy something which can be differentiated by when you buy it, then you can specifically use first in first out or last in first out, depends on you. But if the items are not differentiable, then you have to use weighted average, you don't have a choice, because otherwise you cannot follow the correct policy. Okay, the weighted average cost takes care of your average cost, and so the profitability will remain the same over a period of time. Otherwise it will fluctuate and it's very difficult to explain. Okay, so normally nowadays the most of the companies follow weighted average. And the valuation, that was only the how you charge inventory, but how about the valuation? So valuation normally is done at cost or net realizable value, whatever is low. So if you bought at 10, now the market price is only 8. So if you want to go and sell in the market, you can get only $8. But actually you bought at 10. So your inventory will be valued at 10 or 8? 8, because that is the net realizable value. Okay, the net realizable value minus the cost of sale. If you have to sell, if you have to go to the market, spend another $1 to sell it, so the net realizable value is 8 minus 1, not 8 anymore, so the 7. So the value of your inventory is only 7, because that is what you can realize. Okay, so obsolete inventory. What is obsolete inventory? The inventory which is not usable anymore. Maybe my apple is rotten already, correct? So means we have to continue to look at our inventory every month or every year and see, is it still worthwhile or not? If it's not, we have to charge it off. Okay, the control point in inventory are monthly inventory taking. You have to take in monthly and do the valuations all the time. Okay, because especially for inventory, the value can change, the market prices can change, right? Even for fixed assets or for your purchasing cost, for your selling cost, raw material, whatever, and match with the inventory records. When you take the monthly inventory, same as fixed asset, you have to make sure nothing is stolen by the customers or by the employees. Okay, and then also identify the consumption. Means let's say you have 10 in the beginning, right? 2 you sell, so the balance should be 10, balance should be 8, but and physically is okay, but your sale record is showing only 1, but actually you deducted 2, correct? So where is the difference then? Where the one go? Maybe the staff eat it, correct? So means you need to match your minus consumption with your actual sales record, which is normally happens in especially the consumer graphics. Like for example in hotels, we make, okay, because we cannot control the chef, right? He can eat while cooking, correct? No, we cannot control him, right? We buy him maybe 10 T-bones, but we are selling only 8. The balance of the 2 is eaten by the chef in the kitchen, and we don't have a CCTV, so we don't know. The only way we can know is we check how much he consumed and what did we sell. If there is a difference, means he consumed it or he wasted it. Maybe he not eat, but while making he make a spoilage, or he made didn't was not tasty enough, so he throw it to the dustbin. But for company, we pay for 10 and we get income for 8, which is not a good idea, right? So even though the staff may be honest, but they may be inefficient. So it will help you to understand is there any inefficiency or not. But for that you need to maintain a lot of records. Okay, and then identify what are going to be obsolete or slow moving items. Okay, then normal.